Hi, welcome to our first quarter of 2014 conference call. Now that you reviewed your statements, let's look at what's going on in the market. Now, here's a Dow Industrial Average since 1896. Nice pattern. We hope this market will continue to rise. So let's go back a minute. In 2008, many people had a pay decrease and or they lost their jobs. Consumer spending and our savings rate was declining. We are not spending as much. A tax increase and recession contributed to this. So what will continue to drive the economy recovery? I see four things: housing, domestic energy, manufacturing, and believe it or not, 3D printing. Now, look at the housing sales. They're not up to normal yet. That's on the left side of the graph there. They're not even up to that green bar, so they're not up to normal yet. On the right, foreclosures are down, as you can see in the green. The new home market collapsed from 2.5 million to 500,000 per year. We've had a down year for 6 years and it's now coming back. We only need to build 1.5 million homes to keep up with the population. As you can see in this slide, the mortgage rates are up. This should not affect housing. 3 million jobs were lost due to the housing bust. So we're on our way. Half the jobs have come back, but there's more room to grow. There's not enough real estate supply right now, which should drive up the values. The bank and lending was pretty tight after 2008, so there's a lot more lending now. The debt is down for consumers. Spending on autos and housing are not back to average yet. Again, look at the right. It went way down in 2008, and you can see it's starting to climb back, but it's not nearly back to average. This I found very interesting. This is a natural gas. There's an energy boom going on right now. Horizontal drilling and fracking are big. We have moved on to crude oil shells, making barrels in North Dakota, which is bigger than Alaska, all in the last 3 years. They track for crude oil and turn this into natural gas. Believe it or not, there is zero unemployment in North Dakota, and you can see that up in the hot pink on the upper middle of the U.S. Now, there's 4 other oil shades identified in the U.S., and they're the same size or bigger than North Dakota. Fracking is very high tech. It's very expensive. Exporting won't be for a couple of years. The path that many economists think that they'll take is Texas to Panama to Japan. So keep an eye on the China, because I know that China is pretty desperate for natural gas. So FYI, in 2000, shale gas provided only 1% of the U.S. natural gas production. In 2013, it's estimated 35%, or $4.4 billion industry. You can see from these charts it's climbing like crazy. The U.S. is fast approaching energy independence. The U.S. produces, you can see it on the left side of the screen here, second bar, we produce 12.5% of world oil production. They have an estimate on the right, but I don't care for estimates. I'm just right now telling you what's going on right now. In 2010, there was little infrastructure for transporting oil and gas. See those little dots? There's about 6 dots there. That was our transporting of oil. Now look at it. It's ridiculous. You can see all the jobs created to transport oil to the refineries. There's an estimated 3.6 million jobs created just from this industry. This is a slide that would be neat to look at later, because I'm not going to sit and read through it for you, but the manufacturing renaissance has already begun. These are potential job growth. This is potential job growth in the next decade, and it exceeds 2 million jobs. A little bit about 3D printing. It's in demand and there's a potential growth. Here are some applications. So in the 3D industry, there's going to be a lot of growth in auto and aerospace, medicine and dentistry, personal and consumer products. So now that we covered some examples of what industries may drive the economy, here are some other ideas that also affect the economy. If you look, the unemployment rate is down. Young baby boomers are now retiring. The oldest baby boomers are 68 right now. They stopped working. So the U.S. economy does not have to create as many jobs. Corporate earnings are growing. That's good news for stocks. It's too late to get into the market is what I hear a lot from a lot of people, but that's not true. The averages are still low. The current rally is well below average in terms of duration and magnitude. I see three areas in the stock market that look like they're growing according to everything that's going on. Industrial stocks, large cap growth, and international equities. Bonds, there's a gradual increase in interest rates. If you look at this chart, you can see that it took 18 years to get back up to 4% interest levels from the bottom. So it appears that interest rates have already normalized. Look at the bottom right, that's 9, 10, 11, 12, 13 across. It looks pretty level there. There's no inflation shown here. I'm looking at the top. Everybody always can see that 2000 between 8 and 9 there. So I don't see much going on with interest rates, just so you know. No inflation is shown here. Wages are a key driver of inflation, and they're not increasing either. Demographics also support no rise in interest rates. So this is our challenge with bonds, is that we don't see interest rates going up, so why bother investing in bonds? Well, it stabilizes your portfolio when the market goes down. Bonds are our biggest challenge today. Here are some ideas. Consider changing your bonds to managed portfolios with all types of bonds so that you can navigate all the abrupt changes. Hedge with investment-grade bonds. Commercial real estate has no interest rate sensitivity. It's only got a 2.5-year duration. And you can also do some mixed portfolios that you get your dividends from other than bonds from stocks also, which all of you know we've been kind of driving that way over the last year. I want to thank you all for listening. Until next time, have a wonderful quarter.